Good morning, everyone. Welcome to this update for the 24th of June. Sorry about the gap last week with the video, but I was travelling on the Sunday. And look, not a lot has really changed in the 2-week period. Crude oil's been a bit all over the place, but other than that, markets have gone up and then back again, and currencies have done something similar. And this is fairly typical of this time of year. From my perspective, there are still an enormous number of positives out there, and in my view, markets are going higher. But after such a great run, we've got some volatility, and I think that's probably going to continue. But look, if you're really clear about what you're doing, volatility is great because you just sit back and wait for the little panic sell-offs, and that's an opportunity to buy stocks more cheaply than what you'd otherwise get them for. So don't ever be put off by volatility. I think the concern there is more about the headlines that the media creates, trying to beat up a story than anything else, and it only serves to scare a lot of people out of their positions. So just try and ignore all that noise that's out there and get on with the opportunities. So in this update, I'm just going to have a little bit of a look at what this typically weaker June, July, August period, which tends to be one of the weaker times of the year. Typically, what are the markets indicating that's going to happen this year? The normal stock and commodity trend updates. And portfolio analyst, last week, we looked at a couple of new strong buys in Australia that I really like, and some key updates on some important stocks as well. So the American market, the S&P, was down by 0.9% for the week. A lot of that happening in the last few days. But the Nasdaq and the Russell did make new highs on the week itself. They gave back a little bit at the end, but nevertheless created new all-time highs in both. So they're outperforming the S&P, and that's a very positive sign. Markets had got ahead of themselves up until a couple of weeks ago. They got overbought in the short term, and so we're getting a little bit of a pullback and a consolidation. But that's absolutely normal, and that's absolutely healthy. I really, at this time of year, I don't want to see markets charging ahead of themselves because the bust will be that much more severe. I think the probability of a continued rise in the market is much higher than it is for a decline from here. So that's pretty much the bottom line. And if you don't quite get your timing right, then it doesn't really matter as long as you're buying quality stocks that are in an uptrend, then you'll probably do quite well. One of the key messages I want to get across this week is that the opportunities are just plentiful, particularly in America, but there's also quite a few good opportunities in Australia as well. So, you know, it's just not a time to be sitting back and wringing your hands about all the things that could go wrong, which is what the media would have you doing. The US dollar was down slightly on the week. We had a little peak over resistance, as you'll see on the chart, but we're now consolidating that quite positive move up in the US dollar. So let's take a look at some of the price action. We'll start with the S&P on a daily basis, and you can see that we're still pretty much on trend. So here is the long-term trend that followed through from 2017, and we're just tending now to spend a little bit more time below it, but look, it's only fractionally below trend. So all that's really happened from 2017 is that we've got larger swings around that mean. Now we probably need to start to turn up in the next month or so to retain that trend, but that's entirely possible. So that's the S&P. We ran up, almost got to the 2800 resistance, and then pulled back. What I note is that the daily ranges are quite small. You look at the top to bottom range of these candles compared to the top to bottom range that we had back here in March and in February. So you can see that that's obviously means that the selling pressure has subsided substantially, and it's generally a much quieter market. So I think, given the fundamentals, given the valuation, given the fact that the market has now stopped reacting badly to bad news, it's not necessarily reacting well to good news either, but it's just fairly neutral. And I think, given the time of year, that that's probably about as good as we could expect. So at the S&P index level, likely to track uh, mainly sideways, perhaps with a bit of an upward bias. So that's what I would expect from the S&P over the next few months. But let's take a look at the Nasdaq. So we've formed new all-time highs twice over the last 2 weeks, and you can see that we are tracking above the 2017 long-term trend. So that's a continuation of the 2017 trend, and you can see the price tends to be a bit above it. So there's no question that the Nasdaq is stronger than the S&P, and that's in part a reflection of Amazon, Facebook, Google, Netflix, etc. So they're certainly having an impact on the Nasdaq. But there's also a lot of other technology stocks that are doing very well. So technology in general, unquestionably still leading the market. Healthcare is starting to make a bit more of a positive contribution. That's pretty much the way the market has been now for quite a few weeks. Now let's look at the strongest sector of all, and that's small caps. So this is the Russell. The Russell way ahead of its March and January highs, as you can see. So it's done even better than the Nasdaq. And that's really a reflection of the fact that domestic companies are getting more support. The smaller, domestically focused companies, they're not exposed to the rising US dollar. So that's the first thing, because most of their revenues are in domestic America. And secondly, they're also beneficiaries of the lower tax regime, and also there's been a repeal or a winding back of some of the financial regulations as well that have helped a lot of the smaller part of the financial sector. So lots of very positive things going on in America, and of course that sets the stage and the tone for the rest of the world. Let's just look at the US dollar now. So it's been an enormously strong run up from about 89.5. We got up to 95. Had a little peak intraday over the highs, and then we're getting a little pullback, which is pretty normal. At the moment, the strength is all to the upside, so I think you'd have to expect that the US dollar is probably likely to break this 95 resistance in the next week or two. And the implications, of course, then for Australia are that should continue the downward trend that we've got in the Australian dollar. And you can see that we broke to some new lows during the week, some new short and medium-term lows in the Australian dollar. We had a bit of a rebound on Friday with the pullback in the US dollar, but I think the signs are that'll be temporary. The next support comes in at 73.4. And then we're looking at 71.7. So the near-term direction for the Australian dollar looks to be down at this stage. Let's just look at the overall index for the Australian market before we go back to the slides. So you can see a very positive week. Every day was higher, or three really strong high days, and then really a couple of days of fairly flat trading conditions. There was a little bit of a rise in the major miners and healthcare and energy, but look, it was mainly in the banks. And this was, pretty normal that we get an oversold condition in the banks, and then the computer algorithms kick in, and all the vested interests kick in, and we get a very sharp rally back. That was always going to happen. I don't think it's sustainable for all the reasons that I've been talking about all year with the banks. And and we'll just see how that one plays out. But let's just look at CBA. So CBA on a weekly, so we broke support. We've now had a strong rebound back into the range. That often happens. We could even get back up towards this this declining support line or resistance line now. So if you are looking to lighten exposure to the banks, then if it gets up into this area up here, then this would be a good opportunity to do so, particularly with CBA. So just to summarise, the Australian dollar was effectively flat on the week, but it was down at 73.5 at one stage. 2.1%, 131 points was the overall gain for the week for the ASX 200. But I think a lot of this is about the computer programs kicking in on a rebound in the banks. Not sustainable in my view. Now, precious metals. Gold has had a rough couple of weeks. The last time we reviewed, it was closer to 1,300. We're now down at 1,271. And if you remember 2 weeks ago, we had 4 key events around the G7 meeting, around North Korea, around the Fed, and also the ECB, all of which could have been very positive for gold. As it turned out, that wasn't the case. Rising interest rates are never a particularly good thing for gold, and of course inflation has remained under control. So low interest rates are reversing. That's not good for gold. Inflation is not really picking up. That's not necessarily good for gold. So it's hard to see what's going to drive gold higher from here. Now, as we'll see in a minute, gold has gone right down to the bottom of the upward sloping trend channel. It's now oversold, but I don't have a high degree of expectation about a strong bounce from here. Perhaps some sort of technical bounce looks to be the only hope, because the fundamentals don't really point to a higher gold price. Now, when we look at precious metal stocks, there's still nothing positive, but then again, there wasn't anything negative either. I would have thought that given a sharp $25 move in gold in the last 2 weeks, that we would have seen the stocks come off the boil, but that has not been the case. So I guess sort of a bit of a positive in a way. Okay, let's just take a quick look at gold. So this is gold, first of all, on a daily chart, but we can see it more clearly on the weekly. So there's this inclined upward sloping channel that we've had, which has been in the force since early 2016, so 2.5 years. We're right back down to the bottom of that channel. I think if this channel breaks, then we're perhaps likely going to head down into the low 1200s. That'll bring in a bit of technical selling, I think. So keep an eye on this area. You don't really want to see gold down below about 1260, but I'm not quite sure what's going to push it back up again. And finally, GDX. This is on a weekly chart, and it's sound like a bit of a broken record every week, but you can just see just how flat the major gold miners are around the world. Now, of course, Australian gold miners looking much better because the Australian dollar has been going down, and that's been pushing the Australian dollar gold price up. And we've seen some very, very positive trends in the major Australian gold producers, particularly moving away from Newcrest. So once you get past Newcrest and you drop down into the next 6, 7, 8 producers that are producing somewhere between 200 and 800,000 ounces a year, they've all done extremely well in the Australian market. Turning to other commodities, copper was steady at 308. It was partly currency impact because the US dollar was up and then it was down. But there's also some concerns resurfacing about China with the attempts China has got to reel in the shadow banking system. But look, we've just seen this movie play out over and over and over again since 2012, and it never seems to really lead anywhere different. Crude oil bounced quite strongly, finished just shy of $70. It was a fairly large $5 gain on the week. So there's the moves in copper. Not much happened in copper in the week just gone, but the week before that I didn't report on, there was a substantial drop in copper, and that was really more about the situation with China. This is crude oil. You can just see right over on the right-hand side there, we had a big rebound from 65.5 back to 68.5 during the week, and that was largely on crude oil inventories. But very, very positive on crude oil. Just to wrap it up, on the current positioning, when markets get volatile, it is more important than ever for you to be really clear about what you're doing. You know, what's the game plan that you're following, and the discipline to stick with that, even though in the short term, you know, things may not necessarily be working in your favour. I continue to believe that this is a market of terrific opportunities. There are certainly more opportunities in Australia now. There's some sectors that have been languishing that are starting to look a little better. But the opportunities in America are just absolutely mouthwatering. There's just so many of them. Use the volatility to your advantage. Be patient. Be clear about what you want to buy. Have an idea of what price you want to pay for it. If you don't know how to do that, then you want to find someone that can help you with that. And there's really some great opportunities. Portfolio analyst this week, I'm going to be looking at some methods to generate some significant monthly income. Now, this may not be everyone's cup of tea, but some very, very powerful and very flexible techniques. So that's the update for this week. There's my contact details for anyone that's not a member of any of my 3 services, and I look forward to being back with you next weekend. Cheers.